Well, good morning, everyone, and thank you for joining us for this end-of-year roundup as part of our enterprise series of webinars. My name is Paul Samra, partner at Moore Kingston Smith, and I'm joined by my colleagues Adam, Tim, and Jeremy to help you prepare for what could be in store next year. A tricky task, I have to admit, given that this time last year, who could have predicted the 3 different prime ministers and 4 different chancellors that we had in office during 2022? And it's not yet the end of the year, who knows? So a turbulent year does not even begin to describe it. Far more familiar and customary are our usual housekeeping points. Please put your questions in the Q&A, not the chat function, and there will be a feedback form which we'd really like you to complete. Won't take more than a minute or so. That'll be circulated afterwards together with the recording. So if you missed any of it or you'd like to pass it on to your colleagues, please feel free. Nothing better than avoiding the Christmas festivities on Christmas Day than watching one of our webinars. And looking ahead, our enterprise series will resume next year in January, Tuesday, January the 10th, where we'll be looking at the recent changes to the R&D tax regime. All to come. So now to welcome our panelists this morning. I'm joined, as I say, by Adam Flight, Payroll Director and People Expert at Moore Kingston Smith, a familiar face in Tim Stovold, Head of Tax, and Jeremy Reed, Partner and ESG Specialist. And we'll be hearing about ESG and what all that is all about shortly. So without any further ado, Adam, can I start with you? And I think you've got a poll to kick things off.
Yes, good morning, Paul, and thank you very much. So a starter for 10, hopefully the poll will have just popped up on your screens. So we'd just like to get a bit of information back from you really to start with. So how do you run your payroll and manage HR? Please can you select 2 of the below options? So option 1 is in-house payroll, option 2 is outsourced payroll, option 3 in-house HR, option 4 outsourced HR. So we'll give it a few minutes to see, well, maybe not a few minutes because otherwise we'll be here quite a while, and a few seconds to see how long it takes for people to complete that. Hopefully not too long and it's not too onerous to start things off this morning, and then we'll get the results to see. So quite interesting actually, 50% in-house payroll versus 50% outsourced, with slightly higher in-house HR versus sort of outsourced HR. So thank you very much for those that took part and answered those questions. That gives us a good idea of where things are, and certainly from me, sort of hopefully the answers that we'll be going through this morning will give you some insight regardless of whether you're utilising in-house or outsourced HR and payroll. So Paul, back over to you, please.
Sorry, so Adam, just generally the world of payroll and HR, as we've seen, 50-50 in terms of in-house and outsourced. What's happened, what's changed in your world this year, and looking ahead to next year, what are the challenges and what do you see happening?
Yeah, so this year there's been quite a lot in both the HR and payroll world. So one of the biggest cases that kicked off a few months ago was the Harper versus Brazel case, which culminated in the changes to the way holiday pay and entitlement for casual workers is calculated. This primarily has an impact on those that engage permanent casual staff, and it does away with the 12.07% accrual that everyone had been used to doing for however many years. So if any of you are still using that, I would strongly advise that you have a look at your internal processes to sort of see what you need to do to recalculate things. But in essence, it places a lot more admin burden on yourselves as payroll and HR professionals in understanding how to calculate sort of someone's holiday pay and entitlement for those that do variable hours week in, week out. As many of you are aware, there was the NI levy that was implemented and then removed, and thankfully there's no word as to whether it's ever going to be brought back in, but we'll see what the Chancellor has to say in the coming months and years as to sort of how they're going to pay for health and social care sort of in the future. But hopefully many of your employees in November and obviously December will have seen a slight increase in their net pay, which is a nice thing given the cost of living crisis that we're all facing sort of at the moment, and with the other uplift in tax thresholds and everything else, they probably saw a bit more of their net pay if they hadn't received a salary increase compared to sort of May, June time earlier this year. We've got IR35. It was in, then it was out, then it's in, and it's going to remain sort of in place for the foreseeable. So for those of you already operating it, carry on sort of as you are. However, a word of caution, there are certain government departments, DEFRA I believe were one that were picked up on for not operating sort of IR35 correctly, and have been landed with a large fine. So if you do have any IR35 workers, it would be prudent to review your processes and procedures to make sure that you are doing things properly. 6 months ago, the 4-day work week trial began with a number of pilot companies, and in future webinars that we're going to be running in MKS, hopefully in March, we're going to be reporting on the findings of that sort of outcome of the trial to see sort of what that entails, what it means for businesses, and hopefully report on sort of what you can do to possibly consider and implement it. And then hybrid working. Lots of people are back to work with the train strikes and everything else. I'm sure many people are working from home and perhaps even logged into the webinar from home today. But that's going to be a big thing sort of moving forwards, and it's probably going to be one of those things that attracts and retains talent in the future in your fight for sort of good talent and making sure that you're hiring the right people. When it comes to challenges though, Paul, looking at ahead at 2023 and beyond, as I said, keeping talented employees, how you keep them engaged, retained. It's not necessarily always about cost of living and keeping up rates of pay with inflation. Yes, we've seen a large increase in the number of sort of vacancies out there and the salaries sort of being offered, but I don't believe that's going to be sustainable sort of moving forwards. Otherwise, sort of lower level sort of roles will sort of effectively overtake a lot of traditionally higher paid roles. So we'll keep an eye on that. How to deal with cost of living crisis, particularly for those employees who are struggling. I think that's going to be specifically key over the next 6 to 12 months when the price energy cap gets removed next year. Nobody knows what impact that's going to be. So employers and employees are going to need to start having sort of open and frank dialogue as to what they're going to do, if anything, to support their employees sort of through that. And companies, they need to look at their own costs and overheads and see and look at smarter ways of working. It may be looking at hybrid working and looking to downsize their office space and better utilization of the desks that they have, whilst maintaining sort of team working and collaboration. So that's just a few things from me regarding what's been happening over the last 12 months and challenges that I see happening next year.
Thank you. Thanks, Adam. I mean, certainly all these recent issues that have come about post-COVID have provided an enormous number of challenges for leaders in business. And there's, I suppose, a bit of dipping your toe in the water to see what suits, and communicating well being absolute key. And I dare say employers post-COVID have really ramped up their communication methods with their teams to get the best offering that matches their expectation and their needs, really. And in the world of retention of staff and talent shortage, that dialogue and having your finger on the pulse is absolutely vital. So in terms of surveys and that sort of thing, feeling the temperature of the workforce and how things are moving, you'd recommend that?
Yeah, I think certainly looking at sort of engagement, looking at the talent within your own sort of company, and seeing how you can utilize that best. So engagement surveys, sort of team working and collaboration will certainly give you an insight. And I know that in the news at the moment, there is a lot of talk about the cost of living crisis and price going up and everything else, but I don't believe it's just about that. At the end of the day, yes, people are going to be worried about sort of their bills and where their money goes and everything else. But at the same time, they need to be engaged and have a fulfilling role and feel like they're contributing to the business. And I think having their voice heard to make small changes internally, whether it's the way that they work, the environment, small sort of office socials, using the trivial benefits thing that employers can do, all of that really does and can go a long way to employees actually sort of feeling fulfilled and sort of engaged, other than sort of just the salary element in itself. And I think any company that does that well will not only be able to retain good talent, but hopefully through word of mouth, and there are websites out there, Glassdoor and everything else. Glassdoor, some people see as a way that leaving employees leave negative feedback, but encourage your existing good employees to put positive feedback sort of on there, so that people, because candidates are weighing up the pros and cons when they're looking at different employers, and it's not just about who pays the most salary, but who offers hybrid working, who offers perhaps a 4-day working week. It's all about that sort of work-life balance and making sure that people feel engaged when working.
Great, thanks, Adam. Well, certainly there are challenges ahead in the HR and people sector, no doubt about it. We'll come back to you later, Adam. Time to move on now to Tim, familiar face, Tim Stovald, our Moore Kingston Smith Head of Tax. And Tim's going to kick off with a poll as well.
Yeah, mine's more of a pop quiz, so hopefully that will appear on screen. So what's the top marginal rate of tax and national insurance in the UK at present? You've got a choice of fairly scary tax rates there, and advance warning, it's a completely trick question, which might give away some of the answers. And we shall see. Well, there we go. So 45% is absolutely, definitely the top rate of income tax. But so income tax and national insurance we were looking at. So the top rate of income tax and national insurance is 47%. But then you have to start playing around with the fiddly rules. So between 100,000 and 125,400, as people start to lose their personal allowance, that effective rate creeps up another 20%. Well, yeah, 47 to 62 it will go. So 62, 60% effective income tax rate, 2% national insurance. And then this is the trick bit, because I only asked about income tax and national insurance. For anybody in the unfortunate position of repaying student loans, if you're earning above about something between 20 and 27,000, depending when you took your loan out, there's an additional 9%. So if you're in that 100 to 125,000 pound bracket, paying 62, you're also going to be paying 9% of your earnings off to your student loan. So that takes your the deduction from your salary up to 71% in that bracket. And that's the ridiculousness of where we've ended up. And appreciate that's a repayment of a loan rather than a tax. But for many people, they will never pay back their student loans. It's a payment that they'll make for 25 or 30 years of their working life. And it is, in my mind, just like a tax for a lot of people. So we are ending up with a tax regime that is pretty high, and no great effort being made to change that. So Paul, looking ahead for the year, what's on your mind?
Well, I've got the spring budget, which looms, and with all the talk that Jeremy Hunt has been putting forward, there's only one way tax is going to go, surely.
Well, there's a question of what's left, really, because they've already jacked up the corporation tax rate, will be 25% from April of next year. We've got the 45% income tax rate now only applies from 125,400 rather than 150,000. The dividend allowance is on its way down. The capital gains tax annual exemption is on its way down. So they've played with most things. The spring budget, though, I don't think the economy is going to have turned a corner sufficiently, and inflation's still running very high, that there will be more to be done. The rumours, and we play this game much like every other firm of accountants. Capital gains tax, I think, is the rate of capital gains tax. I still think is an area they will look at. Boris Johnson and Rishi Sunak, when they were Prime Minister and Chancellor, said it wouldn't raise any money, and there are various think tanks out there that said an increase in capital gains tax rate to income tax rates would raise 8 or 9 billion. But the counter argument to that is if the rate goes up significantly, people will hold on to assets rather than sell them. But I think there will be, as there always is in the run into a budget, a rush to sell assets. If you know you're selling an asset anyway, whether it's a company or an investment property or whatever it might be, there'll be a rush to get those transactions done before the spring budget, because when the capital gains tax rate goes up, it goes up from the date of announcement. It's not, you don't get prior warning of it. We've got precedent as it's changed over the years that we've had 2 rates of capital gains tax in the year. So that's one thing that could get another look in. Inheritance tax hasn't had much of a look in recent budgets. I always fear that there's going to be a super rate of inheritance tax for large estates, that the tax rates are banded across everything else, but a flat rate of 40% above the exemption. If you've got an estate that's 100 million, you can see that they might introduce a higher rate, but inheritance tax has always been an optional tax for those who've got the flexibility to plan and give away in lifetime. So inheritance tax probably would get some look in, I think, but maybe a consultation rather than any changes on the day, because it's a very sort of spider's web regime to change. If you change one thing, then there are consequences across all other aspects of the regime. So difficult to change, but that will get a look in.
But more estates are coming in to the inheritance tax band because of property values and the way it's remained unchanged at 325,000 for.
Yeah, so the 325,000 threshold was baked in for goodness knows how many years now. It hasn't changed for a while, and it's baked in for another 3 or 4 years that it won't increase. We've got the main residence annual exemption as well, another 175, but that's not available to all estates. But yeah, more estates will come into the inheritance tax threshold, which doesn't really help social mobility. If what you're trying to do is pass wealth down the generation, if it's actually going out the door to the tax man, it's not allowing families to sort of climb their way up the ladder. So it's not a good tax to increase on the way into an election. So possibly on the way into an election, given we've got a general election in 24 or 25. We may see some relaxations around IHT, but it's something that needs looking at. They've consulted on it many times and not really grasped the nettle, other than freezing things. So IHT, I think, will get some change on it. If they want to win some votes, they'll relax the system. If they want to raise some money, then they'll make it even more harsh than it already is. The other area that the press get excited about on the way into a budget, and have done almost for as long as I can remember, is pensions. And everybody says, well, that tax-free cash is going, you won't be able to draw your 25% out. There'll be a restriction on the amount of income tax relief you can get, rather than at your highest marginal rate, reducing that down 30%, the number that people have always bandied around. The government have been pretty silent on it, other than continuing to release statistics showing how expensive the pension regime is. It costs 30-40 billion a year, the suite of pension tax relief. So just turning the dials on those slightly would raise far more than a CGT or an inheritance tax increase. But again, would upset a vast amount of the voting population. But those are my 3 bets for the spring budget: a CGT, possibly increasing the rate, some tinkering with IHT, but maybe just a consultation at this stage, and maybe a look in on pensions. But if the economy starts to turn a corner, the spring budget will just be self-congratulatory. They'll stand up and say, what we've done has worked, business as usual, some minor announcements and nothing major. But if the economy's still not doing so well, they'll have to do something just to keep the markets happy that they're taking action to increase the Treasury's take.
The budget date, has that been set in March yet?
Not that I know. I've got a number of transactions on, particularly so employee ownership trusts. And please don't. I'm not spreading any scare stories about the store. Employee ownership trusts are the thing that we're doing the most of at the moment. We're starting a few now, and some of the conversations we're having are wanting to get them completed by the spring budget date, just in case there's any tinkering of that regime. The general view is there won't be. They're popular. They serve a purpose. They're not being abused. But we're working on getting those done by mid-March. So I put my finger on the 15th of March. It could be earlier. It could be later.
But realistically, with the Christmas break and the inflation percentage that's just been released, effectively they've only got 2 months to fiddle around and come up with. And I can't see the economy turning to that significant degree, I would think, to change things. A lot of talk about non-domicile rules, non-dom rules. Do you think they're going to be tinkered with and scrapped?
Well, they've been around for a very long time, and those who are not familiar with the non-dom rules, although they seem to be in the papers most days, that's allowing people of overseas origin, so generally foreign nationals, to come and live in the UK, and they only pay tax on what they earn in the UK. They don't pay tax on what they earn abroad unless they bring it into the UK. So that's the basic version of the non-dom rules. There's various aspects and are quite illogical around trusts, that non-doms can have trusts that are forever outside of inheritance tax, and that the FT write about that fairly regularly as being an illogical part of the tax system. So it's difficult, really. I think if we had a change of government, that they're gone. The Labour Party have already said the non-dom rules will be scrapped, and that will be part of their pitch going into the election. Various numbers have been crunched over the years to say, look, are non-doms a cost to the economy or a benefit to the economy? And looking at the tax paid, the last stats put out, which must be 3 or 4 years ago, said there were net contributors to the economy, but that the man on the street probably thinks it's not fair that, you know, they might be living next door to an oligarch who more or less puts zeros on their tax return because all of their wealth is outside of the UK. So if the Conservative Party wanted to do something that just appeased some of the concerns that the man on the street has, which is what they tend to do on the way into an election, they would shorten the period that an individual could be non-domiciled whilst living in the UK. So it used to be forever, and then it was shortened to 15 years, and it becomes increasingly expensive to be a non-dom in terms of the charges that have to be paid to be non-dom up to that 15-year period. Now, I think where at least the press are going is, look, we quite want US investment bankers to come to London and work for a few years and pay lots of tax, but we don't necessarily want individuals coming to the UK and making the UK their home and basing themselves here and having a tax advantage when they're really enjoying all the same services that anybody else would in the UK. So if you look at a typical secondment, if you've got high earning people coming to work in particularly the financial sector, 3-4 years would be a period that would work. So that may be where we see a Conservative Party restricting of the non-dom regimes. The Labour Party would scrap them altogether. But I think we always have to have an eye on what's happening elsewhere in the world. Portugal, Italy, they both have non-dom regimes. They're both proving very popular. I think Portugal's is for 10 years, Italy's is for 15 years. So these jurisdictions were inspired by the UK non-dom regime and how successful it was attracting wealth into the UK. And, you know, if we are going to scrap it or restrict it, I think somebody ought to crunch the numbers again to see what the cost to the economy would be, not of people leaving, which is where people focus, but of people not coming in future, which is a difficult thing to quantify.
Just don't get the previous Chancellor, Kwasi Kwarteng, to crunch the numbers. Anyway, upcoming, as I mentioned earlier, we've got a webinar on the R&D tax regime. Just maybe some headline comments, Tim, on the changes that were announced by Jeremy Hunt.
Very disappointing, because the justification for restricting the R&D regime for SMEs, and it really is very, very important to a lot of SMEs, was that it was to counter fraud. Well, if you want to counter fraud, you don't reduce the generosity of the relief, because you're harming all those legitimate businesses claiming it. The revenue do need to get to grips with fraud, but they've tackled it, in my view, in the wrong way. So what we've got is, the most popular claim under the SME scheme used to give back £33 for every £100 spent on R&D, and that's now being reduced from April next year to just shy of £19. So it's a massive cut in the funding available. The large company scheme, which has less fraud, has been made more generous by a similar proportion. So large companies used to get back about £10 or £11 for every £100 spent. That will now become £15. Now, is there any silver lining to this? Well, look, not for SMEs. SMEs ought to get as much of their R&D done before the 1st of April next year to maximise the claim they've got. But one thing that SMEs ought to look at is, if you were claiming under the SME scheme, in general, you couldn't then claim under any grant scheme as well. So you couldn't apply for a government grant, because otherwise you were getting sort of double bubble on your incentives. You're under the SME scheme, very generous, and you're also getting grants. If you applied for a grant or applied and received a grant, you could only claim under the large company scheme. And I think what's going to happen post-April is SMEs are going to look back at what grants are available, because a grant plus the less generous large company scheme might now give them more funding than claiming under the SME scheme. And secretly, I think that's what the government want. They want a single R&D scheme. Grants are much easier to police in terms of fraud. The large company scheme is easier to police than the SME scheme. So the SME scheme eventually will wither and die, but we're talking about over 3 or 4 years. But yeah, it's sad to see something that was of such importance, particularly to our clients, really being killed by stealth through these changes, making them less generous.
The wrong reason. Yeah. Great. Okay, Tim, thank you very much for that. I'm sure we'll come back to you if time allows. And now I'd like to move on to Jeremy Reed, partner at Moore Kingston Smith. And Jeremy heads up our ESG group, environmental, social and governance. So Jeremy, I think you've probably got a poll as well, if my crystal ball.
I do. And I think this is a relatively straightforward one for everybody. So after Tim's challenging question, I've asked something slightly easier. So if I think about why is it that businesses consider ESG, and basically, is it a result of thinking about reputation? Is it about improving risk management? Is it about driving innovation, cost of capital, access to the best people, or is it about all of the above? Relatively straightforward, I'd hope for everybody to answer just to get us started. Excellent. So, and actually, I actually really like that response, because on great. Thank you everybody for getting it right. So it is about all of the above. But interestingly, one of the key things, obviously, with ESG is thinking about the impacts or effect of things like greenwashing. So reputation, it is very important, but actually one of the things that we spend quite a lot of time thinking about is making sure that what people are saying about ESG is true and accurate, and isn't necessarily wanting to portray things in a way that's better than it could be. So I think, yeah, really, really helpful. And I guess following the format, Paul, what questions do you have for me?
Well, does my business need, in today's world where everything is limited, we've got limited talent, we've got limited resource, limited costs, limited budget, do we really need an ESG strategy?
I think the short answer is absolutely. The slightly longer answer is actually question whether you need a kind of ESG strategy on its own, or whether actually ESG should be interwoven in everything you're doing in a kind of broader strategy. And I think that's where, that the changes, if you look at a business from an ESG perspective and you move away from purely a financial perspective, which perhaps is a lens that a lot of people would do, it actually looks a little bit different. And actually, when I think back to what Adam was talking about, people, so the S of ESG is around people. Depending on the type of business you have, the E will be more or less important. So in professional services, for example, E becomes less important than it would be in a large manufacturer, for example. And the governance part of this is all around getting, tone at the top, making sure that your organizations work in an ethical way and a well-organized way to help you deliver on the things you want to deliver in terms of profits and purpose. So I think the interesting part is the best businesses in ESG are those who will have ESG strategy intertwined into everything else. So for example, if you're doing a risk register, you can do a risk register for ESG and you can do an ESG, a risk register for the rest of your business, or actually you can have one which covers all of it. So what we're encouraging people to do is to think about ESG as kind of part of what you do rather than something that's separate.
And for someone starting out on the ESG journey,
yeah,
it almost seems a mountain to climb. And for the size of business that you may be, a small, medium-sized business, I mean, to what extent should you throw money at it to get the right input into an ESG strategy? I mean,
yeah, it's a great question, and I think ESG historically has been focused at the largest companies. So if you look at the reporting requirements, the formal reporting requirements apply to very large companies. over the next, in April 24, that's getting moved down to UK private companies, 500 million and 500 employees. That still sounds like quite a lot of people. But I think what we're actually starting to see, though, is things like cost of capital can be much lower if you're a smaller business as a result of things like ESG. Your ability to retain people can be that much greater when you get ESG right. So I think, is it important for businesses of all sides? Absolutely. One of the things I always do, it's a fun thing to do. So if you want to understand the importance for ESG, just look at company websites on particularly on consumer. What you'll notice now is most consumer websites will have a little bit of ESG, irrespective of the size. And I think what we're starting to see is every business understanding that ESG is relevant, because you're going to be asked about it for when everybody's trying to understand what's going on in ESG in their supply chain. So if you're in somebody's supply chain, it's important that you are able to articulate where you are on ESG. And if nothing else, that's a very business-led response. Equally, for attracting talent, one of the things is we love attracting Generation Z talent to our business. It's really important. ESG really matters to Gen Z, and therefore I think that again, there's a very simple reason to say, well, why wouldn't you want to get people involved?
And how to begin?
How to begin? So I mean, it's interesting. More on a global level, we do a lot of ESG work, and what we've actually got a kind of 0 to 4 scale of where businesses sit. So if you're starting at 0, it's basically you've just about heard of what ESG stands for. At 4, I'd probably describe it as ESG native. So this is where ESG is at the absolute heart of everything that the business is doing, and most people will be somewhere in the middle. So you probably then want to think about the degree of how visible that is to the outside world. So I'd probably characterized it as, in the early stages, it's about bringing people within your organization on a journey to understand where you are on ESG. And there's a variety of ways in which you can do that. But in very simple terms, I'd recommend everybody to do effectively a bit of a gap analysis of where do you think you might sit on ESG as headings, and we can help people with asking some pretty good questions in there. Work out where you are, where you want to be, and if nothing else, that's a pretty good starting point. For those who are a bit more sophisticated, there are some interesting reporting standards out. There's a lot of noise at the moment around reporting standards, but actually you get to a point where you can come out with some formal information for the outside world. You can get that certified, you can get that assured. That can be particularly helpful. And then you go to the other extreme where you're having to produce some pretty significant reporting as a matter of routine, and measuring, for larger businesses, obviously measuring your emissions, and then having to go through things like analyzing where your supply chain sits, and some of these things can get quite complex. And then, I think for most businesses, probably getting to kind of that 2 out of 4 by the middle of next year would be what I would be suggesting to people.
And along the way, taking your people with you, I'd suggest communicating that you are starting out on the journey, and so they're aware, rather than because it's something that they can get involved in, your teams, rather than it being presented to them as a sort of fait accompli, but actually, getting them involved. And the important point there about talent retention and talent recruitment, when you are waving the ESG flag, quite important, because if you don't, you'll be found out. And also the answers, I suppose, to the ESG questionnaire that you put forward, or ostensibly what the company says it's doing, it can be quite obvious if you're not doing it. So don't just window dress and pretend that you've got things covered when you haven't, I guess.
Yeah, I mean, we're really lucky. So we're growing our ESG team, and it's a really, really good team. Actually, one of the things that we task ourselves with every single time is looking at whether everything we say is entirely authentic. And I think that's a really good starting place for ESG. But I would also say that the level of engagement we have at all different levels within the organization, it's really exciting. And it starts bringing together, some really important parts of your business. EDI, I think it's really, that's something where, we're starting to join up our ESG and EDI. It means it's amazing as well when you start looking as a business at those measures that really matter, perhaps some of the people measures, and your key performance indicators can look quite different quite quickly. So suddenly you're looking at what really matters in terms of how do we hold on to people? What are the sorts of things that make people want to join? What makes people one of the things ESG is very exciting for in business is actually, I think you suddenly find you've got a bunch of people who they just want to do ESG as kind of a significant portion of what they're doing, whilst having a specialism that does other things. So you can have ESG people in tax, you can have ESG people in audit and payroll, etc. So I think I think by the end of 23, I mean, I guess we're a little bit crystal ball here. I think 23, everybody will be talking ESG. 22, I think everybody's just about heard of it.
Great. And a question in, and just on the subject of questions, please do submit your questions in the Q&A function. We've got about 7 minutes left. So to any of our panelists, Adam, Tim, or Jeremy, please do pop in your questions. Now, a question specifically about ESG. Tim, how do you quantify, Jeremy, how do you quantify ESG reports? One method I've been looking at is using LCA as an indicator. And do you have to have any third-party verification to ensure we're not greenwashing?
So there are a number of different standards that you can report under, and what you can do is get different levels of assurance over whatever you're disclosing. So on one level, you can have effectively limited assurance, which is relatively light. On others, you can go down a slightly more formal route. But actually, typically for things like emissions reporting, that's a little bit more straightforward. There are ways you can get that done externally. There are ways you can do bits of it internally. And there's a number of, there's some quite interesting calculators out at the moment for enabling people to start making good estimates on their disclosures.
Good. Excellent. Well, I mean, ESG, I think, will, as you say, will be the hot topic towards the end of next year. And I think combination of suppliers asking questions and your staff, your teams asking questions. And Adam, bring you in here. Have you seen on the HR side more questions being asked by people in the HR teams about ESG and what new staff might require?
A little bit, as Jeremy said, it's more just getting used to that terminology and what it means. I think next year it will certainly sort of start to make the headlines a lot more, and you'll probably see it more prevalent in job advertising and bits and pieces, in being that much more sort of proactive and clear with regards to where a company stands with regards to it. And like Jeremy said, getting your employees involved in it means that you're not just paying lip service to it. You're not just saying you're doing it for the sake of doing it. You're living it, you're breathing it sort of every single day in everything that you do. And I think that will only become more and more clear as time sort of goes along.
Thank you. And Tim, there's no additional tax relief for going down the ESG route?
No, so, well, there's enhanced capital allowances for energy efficient plant, but no, I'm not sure HMRC have really embraced their ESG reporting yet.
No. All right. Any other questions as we near the final 4 minutes or so? I think it's a very useful whiz through as to what might be coming up down the line. We can look to be another challenging year, hopefully with less challenges than this year, because certainly from a accountancy and tax perspective, it's certainly been tricky for us not knowing which percentage rate we should be applying at what time. It's certainly been interesting. So with that, I think just a reminder that we do have our next webinar in our enterprise series on Tuesday, January the 10th, and that's on R&D and the changes to it, which will be good listening and watching. So can I thank our panelists, more importantly, you all out there for watching. I hope you had a good journey into work, challenging as it was with the train strikes, and indeed for joining us throughout the year over a number of webinars that we've run. I hope you found our series helpful and informative, and we look forward to seeing you again in early January. And meanwhile, can I just remind you, please, to complete the feedback form, which will be sent to you shortly, together with the recording. And as I say, happy watching on Christmas Day. And finally, can I wish you all, everyone, on behalf of Moore Kingston Smith, a very happy holiday season and a healthy and prosperous 2023. So goodbye from us all at Moore Kingston Smith. Stay safe. Bye-bye.
Thanks.